If you are like me, you may have asked yourself in the past or recently, does it make more financial sense to rent than purchase? It's a great question. I'm Lori Richardson with Cherry Creek Mortgage Company, and today I wanted to just give you a couple of tools to help you dig through this very, very important question. Now, these are tools that we actually ran for two different clients, and I just wanted to kind of introduce the concept today and let you know that we can run these tools for you with your specific financial goals in mind and your specific numbers. So let's take a look. This was a client that I met with this morning, actually, who was considering, should I rent or should I purchase? Now, she is renting the property that she is living in right now, right? The property value is about $450,000, right? That's what we'd have to pay if we were to purchase it. And she's paying rent of $29.50 per month. So we just wanted to, one of the things she asked me to build in is what if rent continues to escalate, right? So that's why you see that. But one of the things I wanted her to see was the difference in net monthly payments. Now, a lot of people think, gosh, I'm either paying $29.50 in rent or I'm paying, or I'm paying $35.08 in this case in terms of buying. So my cost differential, right, the difference in payments is $500 a month. But what we forget when we look at it that way is that we're actually putting $300 a month toward principal, right? It's almost like a forced savings account. When you actually own real estate, every payment that you make, yes, especially at the beginning, a lot of it is going to pay interest. But a small chunk of it, which gets bigger every single month, is going toward paying down your principal. That's what we call amortization, so that we're paying down the loan with a small part of that payment every single month. So it's kind of like you're paying yourself a portion of that $35.08 every month. So really at the end of the day, the net monthly savings might be a little different than you think. So again, we can walk you through based on your situation. Now, this is a huge concept. I think when most of my clients think about paying rent, they think about I pay $29.50 per month in rent, right? Pretty simple. In this case, we think it's the potential for her, she could probably continue renting for 3 years. She probably would own the property longer than that, right? But I wanted to at least give her an idea of what that would look like in terms of how much rent we would be paying over the next 3 years, right? So it came out to be $113,995. So let's call it $114,000 in net rental payments, right? Compared to that little savings account, right? Because she would be paying down her mortgage loan with every single loan payment that she made. So she'd either be paying $113,000 or let's call it $114,000 in rent, or she would be building up this little side savings account so that she could kind of get an idea of what that would look like. Now, when we put the net cost, meaning we look at after we've paid ourselves principal compared to what we pay in rent, the net cost of owning versus renting, not that different, right? And look what the equity she would be building in this property over the next 3 years if she were to think about buying. Now, this is in today's interest rates, you guys. More than likely, we will be refinancing her in the next 6 to 12 to 18 months, right? But I went worst case scenario and said, what if we didn't, right? What if we didn't refinance her? What would it look like? Excuse me. So then we moved on to looking at her net worth. If she rents, she basically makes that $29.50 a month payment, right? And it might go up, which we're accounting for. But at the end of those 3 years, she hands over the keys and she's done, right? At the end of 3 years, if she owns, because the property value has continued to, more than likely we will see it appreciate, right? I just threw in a rate of 4%, which is probably still low. But at the end of those 3 years, now her net worth is literally $125,000 because we were able to leverage that property. I ran everything. She's considering putting 10% down, which is about $45,000. And assuming that each month, again, she's paying down her principal, her net cost of purchasing is about $114,000 over those 3-year period. That 3-year period, we think the value of her real estate, again, just assuming a 4% appreciation rate, is now worth about $518,000. Her loan balance has been decreasing each month, so her total equity, meaning her share of the property, is $125,000 over that 3-year period. Now, At that point, she could take that property and sell it and take her $125,000 and purchase something bigger in a different place, put that money in savings, whatever she wanted to do with it. But this was really, really compelling to me, looking at a difference after a 3-year period of $125,000. I thought that was pretty unique. Here's a different tool. And more than anything, I just want you guys to know we can run these tools for you with your specific numbers based on your specific goals. So just more than anything, know that they exist. This is a different tool that we ran for a different client who's thinking about buying a $505,000 property. And this helped us to understand, these blue lines here help us understand from a cash flow perspective. In this case, our cash flow is lower from the very beginning. We're putting 20% down on this property, but it helped us to be able to see graphically and in like dollars, how much is it going to cost us to rent versus buy from a cash flow perspective, right? Every month, am I going to be losing? Am I going to be gaining? What's that going to look like? So this chart gives us the ability to, let's say you really want to get granular and you have a specific property in mind, right? We can actually put in what we think the anticipated appreciation rate is, right? We've got forecasts for each different county in Colorado. We've got historical, so we can look back 63 years and see what the historical appreciation was. And we can use any of those numbers that you want to see. We can also look and say, okay, how much is it going to cost me to purchase this new property, right? There are some closing costs involved in that. And if I were to sell it in the future, right, how much would it cost me to sell it? All of those things need to be taken into consideration when we're looking at this. The other thing we look at is the tax benefit, right? How much am I going to benefit from a tax perspective if I can actually now itemize my deductions? And it helps us come up with, in this case, we looked at this property over a 10-year period. The net gain by buying a home, $474,000. We took into consideration, again, we added the appreciation we're anticipating. We're adding the amortization, right? We're paying down that loan every single month. We deducted out the real estate commissions. We just assumed 6% at this point. We added in the tax benefits to give this client a real example or a real idea of what we think the net gain from buying a home, in this case they're thinking about keeping it 10 years, will really look like, right? Sometimes if we're only going to hold it for 2 years, it might be negative, right? Really, really important analysis to do. So last couple slides I just wanted you to see, and again, we'll run these for you. One of the things that has really been bumming me out lately, if you look at the net worth difference between people who are renters and people who are homeowners, it's been widening by a fair amount. So when we used to look at this in 2010, so right after the Great Recession, right, we saw the difference in net worth between a renter and a homeowner at $181,000, right? A renter's average net worth was $5,400. A homeowner's net worth was $187,000. So the difference there was $181,600. So 1,000. So then move forward, right? Fast forward to 2013, 16, 19. Look at what happened in 2022. Now, a lot of this has been due to COVID, but look at the difference in the net worth between a renter and a buyer. It's increased to $385,000 difference between those two folks, right? Average net worth of a renter is about $10,400 versus the average net worth of a homeowner of $396,200. So that gap is widening, and one of the reasons is that the homeowners are using that home to leverage their wealth and build their net worth over time. So I just wanted you to see that. One of the questions that a lot of my clients ask is, Lori, what's going to happen with real estate values over time? Like I've heard that we've lost value sometimes, and I thought that was such a great question a couple of months ago that we put this slide together for our clients. This gives us an idea of what happened with real estate each year in the United States. Now, the entire United States, right? So it's a national number. We have really good data going back to 1942. But this chart gives us a sense. Every one of the green slots shows us that we actually saw real estate appreciation during that year. The red boxes are when we saw depreciation again across the country, and the white boxes here show that we were net neutral, right? There was no gain, there was no loss, net neutral. You can see that we had 1 year, 1955, where real estate did not increase or decrease in value, right? The only year, 1955. But since 1942, so we're talking 82 years, right? Over the last 82 years, 73 years out of 82, we have seen a net gain, net positive in real estate over that period of time. So I jokingly tell my clients, like, I'll take a 90% win rate all day long, right? If you're going to bet on something with a 90% win rate. Now, that said, I know that there were painful times, right? In the 1990s, we had some painful challenges. This, I think it rounded to zero, but it was actually like minus 0.2%. And then the Great Recession, right? We saw real estate values actually drop. Now, if you're interested, we can walk through why we believe that real estate values will continue to increase. We have a huge supply and demand issue in the United States, right? We don't have enough homes being built, and we have a bigger population coming for the next 24 years, and that's completely out of whack. It's completely the reverse of what we saw in the Great Recession. Happy to run through that with you if you want more details, and we can geek out together. But what I wanted you to see here is if I owned real estate in the 1940s, I know you're surprised, but I wasn't born in the 40s, but I made 129% return on my money, right? Pretty significant. 36%, 23%, again, if I owned real estate for that entire decade. But the interesting thing here for me is look at what happened. Even though we had, like in this decade, in the 90s, we had some painful times, but people that owned real estate still roughly earned 30% on their money, which is huge, right? Great Recession, same thing, 66%, 45%. And look at the decade to date, right? In the 2020s, we're still at 39% overall. So again, there's no one size fits all solution here, you guys. I know that, you know that. But it really helps to look at the data from a numeric standpoint, right? Instead of an emotional standpoint, saying, hey, I think, I heard, I'm not sure. And we really want to help you. We have no horse in that race, right? It doesn't matter to me whether you buy today or 2 years from now, or you decide renting makes more sense. I promise you, we will give you the data so that you can make a really, really great financial decision. So please reach out. We are here to help however we can, and we'll answer any questions and make it as easy on you as we can. Talk to you soon.